It's one of the reasons that the government has resisted so far issuing that budget that would normally have come in March is, as we've been repeatedly told, and as you've heard, that it is hard to make forecasts in this environment. That is certainly true. And as we saw from the jobs data last week, much is up in the air about how even these next weeks unfold. But we're beginning to get a glimpse, and there are some scenarios that'll allow for some planning and maybe even some investment theses. Frances Donald is Global Chief Economist at Manulife Investment. She's with us now. Frances, great to have you with us. And I was not around on Friday for that dramatic jobs number, although, we keep it in context of how bad the job losses were. But just in terms of the pace of the shape of recovery that we keep talking about, I really like the framework that you've offered, which is everybody's talking about phases, right? So we may as well do it here too, but a kind of a phased steps of recovery. And we're in the V shape now, but we don't get to stay there.
No, that's right. And we started to realize that people were really getting really convoluted about the way they were looking at the recovery and choosing to ignore the stock market gains and pushing away the improvement in data because they had concerns about the medium term. So what we've tried to do is say, let's be really clear about our timelines. We are in phase one of the recovery, which will look like a V. Almost all the economic data on a month over month or quarter over quarter basis is going to look better. We've used the analogy of a beach ball that's been held underwater and suddenly released. Now, I'm as bearish as they come. I've talked to you at length about how worried I am about the economy, but that doesn't mean that we can't be aware we are going to see some significant improvements for a short while. The challenge is when we get to August and September, where we go from a recovery to what we're calling a stall out, where a lot of these medium-term trends start to weigh on the economy, slow the pace of job growth, maybe even seeing more job losses, those bankruptcies ramping up, the stimulus falling back. That's where I get concerned. And of course, phase three maybe happens in about 2 to 3 years. That's when all the structural factors like deglobalization and digitalization start to change the economy in longer term ways. But if we really mess up the timeline and we put things like, more corporate bankruptcies in the next month as opposed to the next 6-month period, that's when we get the market calls right. So let's move away from the idea of giving one letter to the recovery and start thinking in phases. The first one through to September, then September for about 1.5 years in that stall out, and then to the new normal.
So then let's focus on the new normal because, Frances, for most businesses, the thinking has to be, right, 3 years, 5 years, when you're thinking about big investments, capital planning, job growth. What do you see that normal looking like in terms of just straight up kind of economic growth?
Well, I've seen a lot of reports, good reports on the digitalization of our economy, de-urbanization, people wanting suburban homes, deglobalization, and those are all very valid and investable ideas. But to me, what we need to be focusing on are some of the larger market implications here, one of which is that we have base bottom interest rates that are not likely to go higher. So we're probably moving into the next chapter for search for yield. That is going to push a lot of people, asset allocators, pension funds, further out the risk curve. It's a structural bid behind equities. Deglobalization, of course, very important to supply chains. Also inflationary. What does that do to the shape of our yield curve? There are changes here that are not just about the shape of our economy, but are actually going to change the way that a lot of our markets are trading. And from my perspective, that right now, if you're playing with markets, is more important than some of the sectoral concerns that we're going to see as people change their behavior slightly.
So, and I guess the other big component of this that we really care a lot about will be where we land on jobs. We're going to see a rebound. So, that it came faster than we thought or in bigger numbers than we thought, I guess, is less material than where we get to. When do you see in that new normal, I guess, going from sort of previous, so let's say January 2020 to wherever we land in 18 months, are we losing a lot of jobs between those two periods in your view, or do we get back to where we were?
Well, we need to think about job losses in two buckets. First are the COVID-19 related job losses that are going to bounce back. Those are going to come back pretty quickly. I'm going to say that 60 to 70% of jobs come back very, very rapidly between now and September. What I worry about is when we get to the fourth quarter of this year, we probably are going to see solvency and credit issues. We're probably going to see the housing market come under pressure. And you're going to have a second wave of job losses that come through the system that are not directly directly related to our shutdown, but are essentially some derivatives of those shutdowns that occur on a later pace. So what I'm more concerned about is that second wave of job losses that comes at a later date, because we won't have the same sort of policy stimulus that's in the pipeline. We won't have the same sort of CERB-like fiscal policies. I think that's going to be more painful, more structural for consumers, and weigh on the economy for a longer period of time.
Frances, always great to have your thoughts. Appreciate it. That is Manulife Investments' Frances Donald.